Hello traders, and welcome back to Explain the Charts. Today is October 14th, 2025, and we are diving deep into one of the most watched currency pairs in the world, the EURUSD. There has been some significant price action recently, with the pair breaking below a critical support level, leaving many to wonder if we're seeing a temporary fakeout or if new lows are imminent. In this video, we'll first cover the crucial news and macroeconomic events shaping the narrative around the euro and the US dollar. Then, we'll jump into the charts, analyzing the daily, hourly, and 15-minute timeframes to identify key levels, trends, and potential trade setups. So let's get right into it. First, let's set the stage with the current events. The US dollar has been showing strength, not necessarily because of stellar US performance, but due to weakness in other currencies. Political uncertainty in France, following the Prime Minister's resignation, has been a major drag on the euro. Meanwhile, the European Central Bank seems to be on hold, with President Lagarde indicating that the rate-cutting cycle is over for now. This creates a stark policy divergence with the US Federal Reserve, where markets are still pricing in potential rate cuts later this year or early next, especially with Danske Bank forecasting cuts. However, the situation in the US is also complex. A government shutdown is delaying key economic reports, creating a data vacuum for traders and the Fed itself. Despite this, the BLS has announced it will release the crucial US CPI report, although it might be postponed. A hot inflation number could force a hawkish repricing and strengthen the dollar, while a soft report would likely weaken it. Fed Chair Powell's recent comments suggest the overall economic outlook hasn't changed much since September, but he did note that tariffs are adding to price pressures. So we have a backdrop of a strong dollar driven by euro weakness and safe haven demand, but this strength is being questioned ahead of critical inflation data. Now let's see how this news translates to the price action on our daily chart. Looking at the bigger picture over the last year, we can see a clear story unfolding. The pair experienced a significant rally from the lows near 1.01 in January of this year, climbing steadily for months. We saw price peak in late August, and then again in mid-September, where it topped out just above the 1.19 level. That peak around 1.19 now stands as a major long-term resistance level. Since that mid-September high, however, the trend has reversed dramatically. We've witnessed an aggressive sell-off, with a series of large, bearish daily candles. Let's zoom in on this recent action from September onwards. You can see the rejection from the 1.19 area very clearly here. The price then sliced through several potential support zones. The most significant of these was the 1.16 level, which multiple news outlets have highlighted. As you can see, on October 8th and 9th, sellers pushed the price firmly below this zone. When a major support level like 1.16 breaks, it often becomes new resistance, a concept known as a polarity flip. This breakdown is technically very significant and aligns perfectly with the bearish fundamental news we discussed, like the French political turmoil. Analysts are now pointing towards the 1.14 handle as the next major support target, as there isn't much technical structure between the current price and that level. Now let's drill down to the 1-hour chart to examine the price structure more closely. This view shows us the price action from the last week of September. Here we can see the battle that took place as the price fell from above 1.18. Notice the periods of consolidation, followed by sharp downward moves. Each attempt by the bulls to rally was met with heavy selling pressure, creating a pattern of lower highs and lower lows, which is the definition of a downtrend. This time frame shows the relentless pressure that eventually led to the break of major support on the daily chart. Now for the most current price action, let's switch to the 15-minute chart, which covers the period from October 9th to yesterday's close. This is where we see the market's immediate reaction after the big breakdown. What's immediately apparent is that the strong downward momentum has paused. Price has been trading in a relatively tight range, mostly between 1.1560 and 1.1620. This consolidation makes sense, as the market digests the recent move and traders await the next catalyst, like the US CPI data. The news mentioned limited movement due to an American holiday on October 13th, and this choppy, range-bound action confirms that. On this time frame, the immediate resistance is clearly the top of this range, around 1.1620. Support is at the bottom of the range, near 1.1560, and just below that is the recent low of 1.1542 mentioned in the news. This range is critical. A break in either direction will likely signal the market's next short-term intention. All right, let's recap the key takeaways and look ahead. The long-term and mid-term trends are undeniably bearish after the break of major support. The short-term trend is neutral and range-bound as the market consolidates. Let's summarize the critical price levels you need to be watching. Immediate resistance is the 1.1600 to 1.1620 zone. This is the old support and the top of the current range. Above that, the next major resistance is the downward trend line, estimated around 1.1680, and then the psychological 1.1800 level. For support, the immediate floor is the bottom of the current range around 1.1560 and the recent low near 1.1540. If that level breaks, the primary bearish target that everyone is talking about is the 1.1400 handle. So, what are the potential scenarios? The bearish scenario seems to be the path of least resistance right now. I would put a 65% probability on this. If we see a hot US CPI report or more negative news out of Europe, a break below 1.1540 would likely happen quickly, putting 1.14 squarely in focus. For the bullish scenario, with about a 25% probability, we would need to see a decisive break and hold back above 1.1620. This would suggest the initial breakdown was a fake-out or a bear trap. A soft CPI report would be a major catalyst for this, potentially pushing the price back towards the 1.1680 trendline. There's also a 10% chance we just stay stuck in this range for a while longer if the upcoming data provides no clear direction. The main thing to watch for is the US CPI report and any further comments from Fed or ECB officials. Ultimately, the market will tell us which direction it wants to go. Be patient and wait for confirmation at these key levels before making any decisions. And that brings us to the end of our analysis for EURUSD. Please remember, this video is for informational and educational purposes only and should not be considered financial advice. Trading involves significant risk, and you should always conduct your own research and consult with a financial professional before making any investment decisions. If you found this analysis helpful, please hit the like button, subscribe to explain the charts, and ring the bell so you don't miss our next video. Thanks for watching and happy trading!